In the first 3 months of 2026, one metal went from $53 a kilogram to $126. That's not a meme stock, that's not crypto, that's neodymium. The thing sitting inside your phone's vibration motor, your car's electric windows, and literally every wind turbine on Earth. And right now, thousands of people are Googling the exact same phrase. How do I buy a rare earth mine? So today, I'm going to answer that. Not with vibes, with the actual math, the capital costs, the profit margins, and the one number that determines whether you make a fortune or lose everything. Because here's a twist nobody puts in the headline. The mine is almost never the business. Stick around because by the end of this, you'll understand something most professional investors still get wrong about this entire sector. Let's start with why this even matters right now in July 2026. Rare earths aren't actually rare geologically. What's rare is who can process them. One country, China, controls roughly 60% of global mining and somewhere north of 80% of global refining. That second number is the one that matters. You can dig rock out of the ground almost anywhere. Turning that rock into 17 individually separated, weapons-grade pure elements, almost nobody outside China can do that at scale. Which means whoever controls that bottleneck controls a huge slice of the global economy. Electric vehicles, wind turbines, fighter jets, robotics, all of it runs through this bottleneck. So the pitch, on paper, sounds unbeatable. Prices up over 100% this year, a metal the entire world needs and can't substitute. Governments literally begging companies to build supply outside China. Sounds like a money printer. Let's find out if it actually is one. Here's the fantasy version, the one you'd get from a mining company's investor deck. You find the deposit, let's say it's a big one, something like the Tonne project in Greenland, which sits on close to 5 billion tons of resource, with a huge concentration of the heavy rare earths, dysprosium and terbium, the ones that are even scarcer than neodymium. You dig it up, you crush it, you sell the concentrate, rare earth prices are ripping, you get rich. That's the pitch. Here's the first problem with it. Raw ore is nearly worthless. What you're actually selling, what the market pays real money for, is separated oxide, pure neodymium oxide, pure dysprosium oxide. Getting from rock to pure separated element requires a chemical separation process so difficult that China took almost 3 decades of state subsidies to master it at scale. So before you've made a single dollar, you need a mine, a concentrator, a cracking and leaching plant, a solvent extraction separation circuit, sometimes hundreds of stages long, and ideally a metal and alloy facility on top of that. That's not a mine, that's an entire industrial supply chain built from scratch in a country that forgot how to do this 20 years ago. And that's before we even talk about what it costs. Industry cost models are pretty consistent on this, so let's use real figures. To get a healthy 20% return on your investment, analysts estimate you need roughly $150,000 of capital spending for every ton per year of capacity you build, and you need a blended selling price of around $70 per kilogram across your whole product mix just to hit that return. Now, here's where it gets brutal. This isn't a low-energy business. Processing rare earths takes over 100 megawatt hours of energy per ton of finished product. For comparison, that's enough electricity to power an average US home for almost a decade to make 1 ton of material. And the carbon footprint matches it too. Over 20 tons of CO2 per ton of product in a lot of these operations. Then there's the part nobody puts on the thumbnail. Radioactivity. Rare earth ore is very often bound up with thorium and uranium. Every ton you process is a ton of mildly radioactive waste you now have to store, monitor, and manage forever. That's not a footnote. That's environmental permitting hell, and in places like the US or Europe, that alone can add years, sometimes a decade, before you produce your first kilogram. So let's tally the actual risk stack for someone trying to own a rare earth mine in 2026. Massive upfront capital, $150,000 per ton of annual capacity, extreme energy intensity, radioactive waste liability, a decade-long permitting runway, and a commodity price that swung from $53 to $126 in 3 months. That last one's a killer, because that kind of volatility doesn't just create upside. It creates a financing nightmare because no bank wants to lend hundreds of millions of dollars against a commodity that can lose half of its value before your mine is even finished being built. Which raises the real question. If the economics are this brutal, why is anyone building these projects at all? Here's the mid-video twist, and it's the single most important thing to understand about this entire industry right now. Almost no rare earth project outside China can get built on private capital alone, not because the deposits aren't real, but because the economics I just showed you are too fragile for a normal bank or fund to underwrite. So who's actually funding this? Governments are. The U.S. International Development Corporation, export credit agencies out of the U.S., Canada, Germany, South Korea, the EU's Critical Raw Materials Act. This financing isn't a nice bonus anymore. Analysts now describe it as the foundation these projects are built on, not a supplement to it. And the clearest example is sitting in California right now. MP Materials runs Mountain Pass, the only rare earth mine of real scale in North America. This mine has an incredible backstory. It was actually the world's dominant rare earth source in the 60s and 70s. Then it lost to Chinese competition on pure cost and shut down completely in 2002. It reopened years later, and even with record production in 2026, their best neodymium output ever, revenue up around 50% year over year to $90.6 million in the first quarter alone, the company still posted a net loss. So how does a company with record output still lose money? Here's the part that should genuinely surprise you. A huge chunk of what kept them afloat wasn't from selling rare earths at all. It was a price protection agreement with the U.S. Department of War, basically the government guaranteeing them a price floor worth over $42 million in a single quarter. That's not a subsidy on the side. In some quarters, that guarantee is close to half of their entire operating profit. Read that again. The government isn't just cheering this industry on. In a very real sense, the government is the customer of last resort, keeping the whole domestic mine economically alive. That changes what owning a rare earth mine actually means. You're not betting on a commodity market. You're betting on a national security policy holding steady for the next decade. And this is where it gets genuinely tense because there's a literal deadline attached to the story. In April 2025, China locked down exports on 7 rare earth elements through a strict licensing system. Then in October 2025, they announced an even bigger second wave, 5 more elements plus a rule letting them regulate rare earth materials even after they leave China if those materials end up inside a product made anywhere else in the world. That second wave got suspended after trade talks, but, and this is the part that matters, that truth expires November 10th, 2026. That's not next decade, that's a few months from when this video is coming out. And we already have a preview of what happens when the tap gets tightened. Yttrium, used to coat jet engine parts till they don't melt, saw its exports to the US crash from over 300 tons to just 17 tons across an 8-month stretch. Aerospace manufacturers are already talking about rationing. The IEA has estimated that if the full restrictions snap back into place, up to $6.5 trillion in annual economic activity outside China could be affected, hitting the auto industry and electronics hardest. So when someone tells you rare earth prices are volatile because of supply and demand, that's technically true. But the real driver is a countdown clock sitting on a trade truce between 2 superpowers. That's the actual asset you'd be buying into. So let's close the loop. Where's the money actually made in this industry? Look at MP Materials' own numbers, and the split is almost poetic. Their mining and refining division, the actual mine, have been fighting for profitability for years.
But their newer magnet-making division in Texas grew revenue over 300% in a single year, and it's already solidly profitable. The mine is the hardest, most capital-intensive, most environmentally risky part of the entire chain, and it captures the least value. The real margin sits at the very top of the finished product stack, the magnet that goes straight into a GM electric motor or a fighter jet. So if you ever hear someone pitching buy a rare earth mine as the move, that's the fantasy version. The real economics say the mine is the entry ticket, the government backstop is what keeps you solvent while you're unprofitable, and the actual profit lives downstream in turning that raw material into something a defense contractor or an automaker can't get anywhere else. Owning a rare earth mine in 2026 isn't really owning a commodity business. It's owning a geopolitical bet with a permitting nightmare, a radioactive waste problem, and a countdown clock that only pays off if you can survive long enough to reach the part of the chain where the real money lives. If you want to actually understand where the smart money this space is positioning, not the mines but the magnet makers and the processors, that's a whole video on its own, and I'm already working on it. Drop a comment. If you had to bet on one link in this chain, the mine, the processor, or the magnet maker, which one would you put your money on? I'll pin the best answer.